Welcome to the weekly rate update. I am your host, Craig Fuller, with my co-host, John Paul, right here from Freight Alley. We're talking about what's happening in the market over the last couple of weeks and what we expect over the next few. I think we would be remiss if we didn't talk about tariffs and the threat of tariffs. I believe it was Thursday, Donald Trump tweeted that he's going to put 10% more tariffs on Chinese goods. What has happened in the market since that took place?
We've heard a lot of talk. We haven't seen a lot of action. I mean, I think it's really important to remember that the Trump administration has yet to finalize the list of goods that are going to be hit, and now we're just about 3 weeks away.
So no one knows the good list, but there has been a track record of threatening and actually following through.
Right.
These aren't just idle threats from the Trump administration on tariffs. They actually intend on putting them in.
Yeah, I mean, certainly equities markets kind of freaked out.
The stock market has gone to hell. I mean, I think last 2 days it's recovered, but it's been sort of tough.
And all of Wall Street's sort of risk profiles for the likelihood of recession have gone up. Those have all been in the news. So, people are taking it seriously. I think that the tariffs will be implemented, but it's still unclear how people are going to respond.
So what do you think this means for the freight market specifically? In the ocean side, what are we seeing as it relates to ocean container rates?
So all summer long, container rates from China to the West Coast, steamship lines have tried to push them up. They've implemented general rate increases, GRIs, at a regular clip, but after they increase the rates, they see them deteriorate pretty rapidly back down.
So their contract committed rates increase, and then on the spot they just go back and undercut it.
Right. The trend is still slowly upward, but not as rapidly as steamship lines would want.
I saw that, I believe it was Hackpack Lloyd actually had a really good quarter, one of the best quarters they've had in a while, related to just rate strength and the ability to get higher rates for container. And container volumes have been higher versus what we've seen in years past.
So I covered the Expeditors International earnings, and they talked about definitely seeing a shift from air volume to ocean. Does
that just mean that supply chains are now, there's so much in the warehouses that there's not as much need for JIT freight, or why is stuff moving into ocean?
I think so. I think that it's air is when ocean capacity is really hard to source, and you have to pay more, and you have to move like that. And I just think that hasn't been a problem as general volumes have kind of come down. I will note that I did see today that Adidas called out air cargo costs in their earnings report. They said that due to a supply issue in the U.S., they had to move a lot of clothing from Asia to the United States on air, and that hit their earnings. And that's the first time we've seen transportation costs called out in earnings, since last year.
Yeah, last year it was almost every major retailer, and in the food sector, it seemed like they were talking about transportation costs. And domestic has been pretty soft this year. In fact, one of the things that I'm hearing is that shippers that either had agreed to higher rate increases, didn't honor the volumes that they had told the carriers they were going to give them. They may have given 40 or 50% of the commitment that they had promised, or they're asking them to claw back those increases. And I'm hearing more and more of that happening. What is it you're hearing?
That's what we're hearing too, and it's really it puts pressure obviously on carriers, but I think the brokerages are getting really squeezed as well, because our data shows that national spot rates are kind of sideways, especially
they're flat.
in major markets.
There's no downward pressure.
Right.
There's no real sort of significant upward pressure at this point.
Essentially through July, they've been.
July is a soft month. I would doubt you would see a ton of upward momentum even in July.
Right. But there hasn't been downward momentum, and there has been downward momentum on the contract side. Yep. And so that compresses brokerages, gross margins, and I've heard basically everyone I talk to is saying we're getting great volumes, but just the top line revenue is not there.
Yeah, I was talking to a large freight broker this week, talked about their bid cycles moving into next year, and was concerned because the fear was if they overbid, if they overpriced, they'd lose out on volume. If they underbid or underpriced, they would continue to get, or potentially get squeezed in margin. And we talked a lot about the sentiment. I think it's a pretty tough spot for brokers right now because, my view of it, I don't know if you agree, but is spot rates are going to continue. I think we've seen the low of spot rates, at least for this year, and probably won't see deterioration of spot rates until maybe January of next year. But I think we've seen the lowest spot rates we'll see all year. And I think for companies going into bid cycle, shippers now doing bid cycle, they want contract rate reductions. And they say, hey, you need to match my contract rate reduction because everybody else is. And so that's putting pressure on contract rates at a time when there's very little movement and downward pressure on spot rates. So contracts going down, spots going up, that means margin compression for brokers.
Yeah, and that's, I wonder, did you ask that brokerage executive about freight futures?
I did ask him about freight futures because he said he was talking about his bid strategy and whether he should, how he should approach contract rates. He wants more market share, wants more revenue.
Right.
But in his concern is that it's going to squeeze a lot of his margin. If he gets all that business, which he wants to be aggressive, he doesn't want to lose out on it. His concern is that it will cost more to buy the trucks next year. And his concern is if he gets that wrong, that could blow his entire business model out. And I did suggest freight futures. I said, there is a great hedge. It's a great way to hedge it. And I said, frankly, in a market where you don't know if the rates are going to go up or down, and I would challenge anybody to definitively be able to say how spot rates are going to look 12 months out. There's we have good data. Arguably, we have the best data in the market. I would love to find the person who has the accurate model because there is no definitive way of knowing what's going to happen in this cycle. There just isn't. So this is the time you want to hedge. When you don't know the direction of where rates are going to head, particularly spot rates, you should hedge. And I think brokers are the most exposed. One of the interesting conversations this same person and I had was the fear of digital freight brokers, the DFM, and the concern that they're getting more and more market share, and that's changing the traditional dynamics of freight brokerage. In the old days, you would expect everybody to there was this group mentality in bidding, is that liar's poker, if you will, where you're not going to undercut margin, you're all going to operate. But these digital freight brokers are willing to take stuff at single digit margins to get market share because they have no choice but to grow, which means that the ability to really go out and manage your margins is completely different than it's ever been.
Ultimately, though, the digital freight brokerages are going to be under the same, if not even more acute margin pressure as the traditional brokerages. So
without a doubt,
we might expect some more VC rounds next year if things don't go their way.
They'll have to raise capital. I think the thing that and this is the comment that I shared, is that the issue for the digital guys, the ones that are venture backed, is they have to grow top line. As long as their investors are willing to invest in the companies with negative margins, and they're buying into the story of get gross revenues higher, and we'll continue to back you because we think you'll have enough scale where you'll be able to leverage this thing. As long as that story remains true, that venture capitalists will invest in businesses for top line growth in freight brokerage, then you're correct. They're going to have to raise capital. If the bubble, if you call this a bubble, or if there's a change in sentiment in Silicon Valley about how a business with single-digit margins work in the freight brokerage business, if there's a change in sentiment, then that could completely change the outlook of their ability to get capital.
Yeah, and I don't think that story is really changing. I think people are still really. I think people are looking at, for example, what Lyft and Uber have done about being able to expand their take rates, and I think that I don't get a sense that Silicon Valley or the street or anyone has given up on businesses like that.
No, I think you're right. I think that's a good point about Lyft and Uber, and as long as they're using that lens to invest in these digital brokers, then they're in good shape. But they will have to raise capital.
And they have multiple levers they can pull with, whether it's increasing prices, whether it's decreasing their costs, not paying as much. offering different kinds of incentives, different things they can do with their head count to increase their net revenue margins. There's ways to
the
sort of...
The market is so big, the bullseye, you don't have to be very accurate in this market because it is so massive.
Yeah, exactly. Why don't we talked about spot and contract. Moving a little bit further down the curve, we did see some futures trading this week again.
So Tom Allen, who leads the futures, it's like he's found a new girlfriend. He's like walking on air. I'm like, Tom. He's got this giant smile on his face because I think knowing there's activity in the market, there's trading, he's very excited. But there's real fundamental trading happening. I think it's certainly rewarding for Tom and us.
Yeah, so we saw trades happen on the Los Angeles to Seattle lane this week on the October, November, and December contracts. So people
are hedging their exposure to rate movement, either up or down.
In Q4 on that, that famous I-5 corridor from LA to Seattle. And those rates were coming in at $211 a mile in October, $216 in November, and $222 in December.
And what does that mean? What is that?
So basically, it's a contract is 1,000 miles, $2.11 per mile times 1,000.
But in terms of, so what do you read? So we have trades happening, but what does that tell you?
So interestingly, the sentiment is that Q4 inbound to Seattle is going to be softer rates than either 2018 or 2017.
Inbound from LA to Seattle.
Those rates are going to be lower, which I think there's kind of two ways to interpret that. One is that traders in the futures market think that capacity will be available and that trucks will be willing to move into Seattle at a lower price because there's too many trucks, not enough freight. I think the other way to think about it is that traders could be expecting, if you look at national volumes, which are still tracking above 2018, they could be expecting a nice volume pop out of the Pacific Northwest, and therefore you don't have to pay somebody as much to go into a market if it's looking more attractive.
It also, to your point, it could be that there's a view that ship lines, the container lines, are going to end up putting more cargo into the Pacific Northwest this year than years past.
That's
because there's been a lot of congestion at the ports in LA.
Right.
A lot of concerns about peak, what that looks like, and frankly, lack of warehouse space.
That's a good
point. As Tacoma and Canada are actually beneficiaries of the constraints in Southern California. So there may be that there'll be more freight shifted to the Pacific Northwest.
Yeah, even I would put Oakland on that list. Along with
for sure.
Prince
Oakland,
Rupert.
in fact, came out. I think we reported Next Trucking did featured an article that was just about Oakland's trying to speed up the process of getting containers through the port faster. And I think there is an awareness that time is money, and everybody from the Maritime Commission to the ports to all the parties want to limit the amount of time that trucks are having to stay and how much congestion is at the ports.
Definitely. So that's going to be something to keep our eyes on. It's just how spot rates move relative to those contracts. And
it's fun. It's still not overly liquid, but I think there is an awareness that I've taught to people that say I don't know the direction of rates. And I had a conversation this week as well with a large truckload carrier, asset-based carrier, and the conversation was about how frustrated. This is a seasoned executive, been in it for decades.
Interesting.
Talked about how frustrated they are the industry because he said, "Look, I went out and I bid and I got awarded all this freight, and the shippers are giving me half of what they allocated." He goes, "I hate this industry." I'm like, "You've been in it for 40 years. What are you talking about?"
It's
like, welcome to trucking. This is 101 stuff.
Right, and I think for the futures market, it's a weird time. We talk about sideways rates. We talk about a lot of uncertainty. We talk about
this is the time people should be hedging because you don't know if we're up or down. And like I said, I don't think anyone can definitively say if the market's going to be stronger or weaker. I mean, my personal view is that spot rates are going to go up. We've seen the lowest parts of spot rates. That into next year, there's going to be upward pressure on spot rates, and there's going to be downward pressure on contract. That's my view.
Right.
But
if GDP goes negative,
if we're in a recession and Wall Street's starting to price that in, the yield curve and such, if we go into a recession, all bets are off.
Right.
But we also could end up with trade policy of being fixed,
Resolution.
maybe. We could end up with an election about just a bunch of money in the economy because of the election. I don't have a clue.
Right. You could see the Fed kind of engineer a soft landing.
Yep.
So the bottom line is that we think freight markets could still break out in either direction.
It could break out in either direction, and I think that's when you would want to hedge. That's when you would want to actually hedge if you don't know the direction, because nobody knows. And
Right.
I would say that I will argue that we have as good of a model as anybody in the market in terms of where it's headed, but it is not precise. It is not accurate, and no one has an accurate model. And there's a saying that all models are inaccurate, some are just more useful, and I think that's true, right?
Right.
Is that we just don't know, and I think hedging is a way to ensure your exposure on either side of it. And so that's really the idea of what people do for hedging. And we'll see. I would love to see more liquidity in the market. As liquidity builds, then that gives us more information, and then we can make more informed decisions about where things are headed. But what do you think for the next week? Are we going to have a good market in terms of volume, or do you think things are waffling?
I think this is, I think we're past quarter end, middle of the month.
It's just a blah.
It's
month.
August. Yeah, I think everything is sideways. Certain markets have more volume than, weird markets like Columbus, Ohio, and Cincinnati.
It's also back to school.
Jacksonville.
People just aren't buying much right now. They're back to school's over with for the most part in most of the country. People are putting their kids back to school. They're tired. They're taking the time off now that the kids are back in school, and they're just not buying much.
I think that's right. So flattish next week, but I think going into September is when we really start to get an indication of what Q4 might look like.
Can't wait. Fall is coming, college football is coming, and peak season's coming. Tune in next week to the weekly rate update as we dive into the freight market, where it's headed, where it's been. JP, enjoyed it. Look forward to seeing you next week.
Awesome.
See you then.